Hello everybody. So in today's video, I want to provide an update on 15 stocks that I cover regularly on the channel, some I haven't covered or discussed in a while. But before I get started, let me briefly tell you about one of the forms of investing that I do on this channel. One of the style of investing that I have is investing in adoption of goods or services, product or service adoption. That's why most of the stocks that you'll see on this spreadsheet are hyper growth stocks, stocks whose products are in the process of getting adopted by the masses. And my style of investing relies heavily on revenue growth, because my style is all about I gotta start buying a stock in the early days of adoption where there's a clear sign that the product is getting adopted. And I typically want to get out in a later stage, right? When it's clear that everybody owns or everybody has that product. You know, the company has now become the new Coca-Cola. The product is widespread. Much of the growth is gone. And then I want to sell and move on to another stock that grows really fast. And this is a period, called the S curve, the adoption curve, lasts about 10 to 15 years, and so I just want to own the stocks during that period of time. And some companies, after 10 to 15 years, they can reinvent themselves and initiate a new S curves, and others can't. So that's my style of investing in a nutshell, which is why it's a style that's heavily reliant on revenue growth. And you'll see many of these companies here are growing their revenue quite fast. And I use my own spin on the PEG ratio of Peter Lynch, but I call it enterprise value over gross profit over revenue growth. And the goal here is to have this number be as low as possible, preferably under a 0.5. And I use enterprise value instead of market cap. Why do I use enterprise value? Because I want to penalize companies that have a lot of debt. I use gross profit as opposed to using EBITDA margin or net profits, net income, like in the PEG ratio. The reason for that is because I am fully aware that good companies should not try to have high profits, right? They should not try to maximize how much taxes they pay. They should try to reinvest as much as possible into the business. And so what matters to me more is gross profit, not net profit, because things like marketing expense, things like R&D in a modern day 21st century type business, I see this as an investment, not necessarily as an expense. And that's one of the key distinctions. And what I added recently to this spreadsheet is the rule of 40. So the rule of 40 is something that we owe to the SaaS investors, right? To the venture capitalists in the SaaS, software as a service business. It's revenue growth plus EBITDA margin, in my case, some profit metric, right? Many use net profit, but for the same reason, I'm not going to like net profit. So I use EBITDA margin because I think EBITDA margin is a better measure of a company's economic cash flow, how much money is left at the end of the year once you've paid for everything and operated the business. So I use EBITDA margin instead of net profit here, or net profit margin, and I add both revenue growth and EBITDA margin. And really, you want to see more than 40. That's typically a sign that it's a good investment. And so now that I've gotten that out of the way, let me get started and tell you a little bit about the stocks in the portfolio. So the first stock that I own, this is my number one position by a long shot, and I've been trying to grow this position as the stock is trading in the 170s, is Tesla. So Tesla and Enphase, and you'll see quite a few stocks that I own that don't rank too well on that spreadsheet. These stocks, in my view, are right at the beginning of their product adoption. So if I look at the Tesla, really these numbers don't work too well, because really Tesla is 5 to 6% of the car market, and so we are very early, and a lot of investors are pricing in so much growth, which is why the valuation, when you look at all of these metrics, that valuation looks high at a 5.8 times sales. And a 2.3 on my EV over GP over revenue growth. That's the highest it's been. And the reason for that is because the revenue growth, say for Tesla, is very small at 14% predicted, while this was a company that the CEO guided a 50% growth in deliveries over the next 10 years. Elon Musk, right, guided that a few years ago. What I believe is that the growth will resume for this company. And this is the type of company where you can't really record or look at the growth on a 1 year period. That is too short when you have products that are very interest rate dependent. And so, the question is, how much revenue growth are you going to have, say, in 25 or 26 when the $25,000 Tesla is introduced and when the interest rates finally drop? Probably the demand and the revenue growth is going to make up for some of that lost growth that we are seeing currently in 24 and that we definitely saw in 23. The gross margin is excellent for the auto business at 18%, and the EBITDA margin is respectable at 16%. So right now, this company has a rule of 40 or 30, which is below the minimum threshold for a rule of 40, but a lot of that has to do with 14% growth. And do we really believe Tesla's revenue growth over the next 10 years is going to be an average of 14% a year? Absolutely not. In my view, it's going to be much higher than that. So I take this number here over the next 12 months for a grain of salt. With a grain of salt, my investing time horizon is much longer than 1 year. Very happy to buy the stocks at this level. Another stock that I own and that I like very much and that I've covered multiple times on the channel, one of them that is actually once again helped by the government in the solar sector. We saw some tariffs in the US getting imposed on Chinese solar panels. Well, guess what? Enphase doesn't do solar panels, right? They do micro inverters. They're a leader in micro inverters, those tiny devices you put under each panel to turn the DC current into AC current. They're a leader, they're a pioneer in this space. And this is a company that's actually predicted to grow revenue at roughly flat, lower than 10%. The reason why I put 10% here is because I don't want to get any of my numbers out of whack. And frankly, I think the analyst estimates are very bearish. This company should, in my view, do at least 10%, at least in the second half of the year when we finally get some rate cuts. It looks like we'll get a rate cut by September right now. I'm really hoping for that, but we'll see. I've been so wrong on rate cuts for more than a year and a half. Who knows? Maybe the Fed wants to create a depression after all. So who knows? But the Enphase is a company that hasn't sacrificed profits to grow sales. They've decided to keep their sales very flat. And as a result of that, their gross margin has still been excellent at 47%. The EBITDA margin is high as 19%. So you get, once again, under a rule of 40 here. But a lot of this has to do with the low growth rate for revenue. So in my view, this is a company whose growth will also re-rate. And again, ask yourself about solar energy and residential solar, right? Enphase mostly does residential solar. Does it make sense a world where every single house has a solar panel on its roof, every single house has a solar install on its roof and creates its own electricity? That to me makes a lot of sense. Roofing is expensive as it is. If you got to replace a roof, might as well put solar panels on it. That to me makes a lot of sense. And so right now I take a walk in my neighborhood in Texas. Less than 10% of the homes have solar panels. To me, 10 years, 15 years from now, most homes will have solar panels. This is a clear case of product adoption in my view, where we're going to go from right now, today, still very few homes having them, to an era, a moment where every single home will have solar panels. And this is something we've seen with the car, right? At some point, nobody had a car, and then in 10 years, everybody had a car, microwave, television, the radio, you name it, the personal computer, right? We've gone through these innovations multiple times. I think the electric car and the solar panel are going to follow these patterns of adoption, which is why I'm very happy to own these stocks, even though right now they don't look too good on my metrics. So I'm slowly going to be moving towards companies that look better on my metrics. So a company which, frankly, Crowdstrike has a nosebleed valuation. When I started covering, Crowdstrike is actually a big position for me now. Crowdstrike is actually bigger than my StoneCo now, and it's also slightly bigger than my HIMS position. That's because the stock has been doing so well. I remember covering Crowdstrike when it was less than a 40 billion in enterprise value, way less actually than that. But we've had so much multiple expansion. Cybersecurity is the recession-resistant part of IT. It is the part of IT that companies really don't want to compromise on. It's also a part of IT, in SaaS that is not threatened to be disrupted by generative AI as much, right? You take a company, say like a billing.com, like bill.com, or a company like a Workday. You could easily imagine an AI building a custom built app to disrupt, say, a company like like a Workday, for example. But it's much harder to imagine that for a company like a Crowdstrike, which has a crowd-based, a network-based cybersecurity network. That's why the market is telling us for a company like Crowdstrike is that these future cash flows should expand well into the future, because the way Crowdstrike work is they have a giant crowd of cloud-connected computers with the Falcon 9 software, and let's say they have hundreds of millions of devices connected to the network at all times. If one device gets compromised, then CrowdStrike can update live all of the other devices on the network, and then know, hey, there's been a compromise on that one device somewhere, and it updates automatically the computers on all of the other companies, such that it stops breaches, right? It stops threats. That's their motto, their marketing. But we understand why it works so well because of the network effect, right? Because of the fact that it has a piece of software installed on so many devices that it will be the first to detect these devices. And so there's a network effect because of that really protects the cash flow of this company, which is why it's predicted to grow still pretty high at 31%. Gross margin is excellent, 75%. And of course, the company here that my metric is telling me at 1.1, it's telling me it's an expensive stock. Well, this time, unlike a Tesla or a Enphase, where you can see the expensiveness of the stock is mostly explained by the low revenue growth, when it comes to CrowdStrike, it's just outright an expensive stock. It's just outright an expensive stock, because I think it's going to keep going at 30%, but that price is expensive. And so, oftentimes this is a company sometimes that I think about selling, but I don't want to pay the capital gains, and therefore I am not selling it just yet. We'll see where it goes. Rule of 40 is almost there at a 40. Keep in mind, this is a business whose EBITDA margin is only 4%, because this business is heavily reinvesting in new products and winning new deals all the time. And another business that I like very much in the cybersecurity sector is Zscaler. So Zscaler is the pioneer, the quote-unquote inventor of zero trust. The whole idea of Zscaler is that, back in the day, companies used to have a trusted network, and once your laptop, say, was connected to the company network, it could freely roam from app to app, from server to server. What zero trust does is it requires authentication within the company's network all the time. So there is no such thing as a trusted device on the network. The network is always authenticating the device. And as a result of that, it creates this idea where if a device gets breached, right? So let's imagine CrowdStrike doesn't work. Let's imagine you're that first device who gets the new virus, and you're out of luck, you get breached because CrowdStrike didn't work, because you were the first one attacked in the whole network. Well, then in that case, Zscaler would protect the company, making sure that only one device is infected by the virus and not the whole network, just one device. That's what zero trust systems do. And Zscaler is a company that, I'm not tempted to sell. I love these numbers. By the way, I didn't calculate the rule of 40 because that's a negative, so we'd be at like a 33%, but we have a slightly negative EBITDA margin. No big deal. For this company, which has plenty of power, plenty of cash, so no big deal, but a little bit of a negative EBITDA margin on them. Still predicted to go at 35% revenue growth. Gross margin is excellent at 78%, and that's why it gets a 0.49 on my EV over GP over revenue growth. Definitely cheap considering the sector, right? Considering that it's in the SaaS business, that's definitely cheap. Now, moving on to the cheapest of the cheap. The cheapest of the cheap is Hims and Hers ELF. So I love this stock. I cover this stock a lot on this channel. The enterprise value over revenue is a 3, so that is a very inexpensive stock, and for a stock that already makes money, a stock that has EBITDA margin at 9%, and so this is the first stock here that is breaching the rule of 40, and note that plenty of them are going to breach the rule of 40 in the stocks that I have on the spreadsheet coming up. So 52% rule of 40, so that's excellent, and the revenue growth is 43%, gross margin is 83%. So again, revenue growth, this company is predicted to grow quite a bit. And what does this company do? HIMSS, well, they are a digital pharmacy and a digital doctor that does not accept insurance. And that is a big deal that they don't accept insurance, because since they don't accept insurance, they can tell you clear pricing. You can know upfront exactly how much this is going to cost you. There are no surprises, no bills that you get in the mail later on, no surprise copays. And by the way, speaking of copays, one of the leading reasons why a lot of people adopt HIMSS is because they look at their insurance and they look at their copay for drugs, and they're like, oh, wait a minute, my copay for drugs is roughly the same as HIMSS, if not higher than HIMSS. Well, let me just go with HIMSS, and they are treating really the patients much more like a customer. They're having a customer-centric approach, all about patient satisfaction, and that explains, for example, things like clear pricing, which is a major problem if you deal with the healthcare system in the US. It's a major problem. Nobody can tell you how much you're going to get charged up front. You find that out later on when you get a bill from your insurance. That's not a problem you get with HIMSS. And they're getting into personalization, they're getting into compound pharmacy. They're also dealing a lot with the doctor's shortcut. There's a lot of shortcut of specialists and doctors in certain areas of the US. Well, because if you say, if you have an ailment of some sort and you want to get treated, because in the traditional system, it would require for you to see typically a primary care provider, and typically you're going to get a referral to a specialist because the primary care provider doesn't want to hurt their liability. So if you take the classic ED journey, for example, the classic ED journey is you may see a doctor, and maybe the doctor can't really help you out, and so they refer you to a urologist, and so that's a process that's like a 6 to 8 months process in some areas, because getting to see a primary doctor in some areas takes a long while. Well, with HIMSS, you can see the specialist directly in less than 48 hours because they have this fully digital system. They have kind of this Uber for doctor. This is a very powerful proposition, one where people, I think, wouldn't hesitate paying out of pocket. And clearly the number of customers, well over 1 million subscriptions, the number of customers for HIMSS really shows that success. Stock is the cheapest in my whole spreadsheet at a 0.08, and I'm very confident in this company's future, very happy to own it. It's a large position for me. Another stock that I like very much is TransMedics, ticker symbol TMDX. So this one is a growth monster. There's no other way around it. Revenue growth predicted next 12 months at 78%. So TransMedics is a organ transplant company. So they have developed the only FDA approved transplant system that we call the organ care system. And what it does is it disrupts dry ice. Still today in the US, if you need to have, say, a implant, like a heart implant, typically, unfortunate, someone passes away somewhere, and so you have a surgeon that comes, the heart is removed, and it's put on dry ice, and then it has to fly on a private jet to the other side of the country to a potential recipient, and many of these organs just fail, and many of these transplants do not work out. Well, TransMedics, same process. Unfortunately, somebody passes away. Unfortunately, a surgeon has to collect the organ, but once the organ is connected, the organ is connected to this organ care system, which is a nice machine, kind of an artificial womb, but for organs, and the organ is kept alive within the machine. And then TransMedics, as its own private jet company where they have a bunch of small jets. They bought last year, they bought a flight school. They shut down the flight school for the jets and for the pilots, of course, and they kept the pilots of the flight school, and now they have their own dedicated team of jets, of private jets, to move the organs from place to place. And their goal is to have 10,000 transplants, to do 10,000 transplants within a 3 to 4 year period. So the growth was guided to continue. The growth has been guided to continue. That's why the stock also exploded a few days ago. And at a 0.32, this is a stock that is actually cheap in my spreadsheet, even though it looks like it has a nosebleed. The price to sales at almost a 16. But when you take into account how quickly it grows, how profitable it is, and how strong the moat is, healthcare is such a situation where they are protected from competition in theory, right? In theory, because of that, they're able to grow without much competition, and that's why it is the highest Rule of 40 as well out of all of the stock. And that Rule of 40 they mostly owe to that outstanding growth. So I'm very impressed by this company and very happy to own it. Now, moving on to Oddity. Oddity is a company at the intersection between beauty and AI. So their main product is called Tech-Il Makiage. It's a foundation product. So a lot of women, when they buy their foundation, they have a very hard time finding the foundation that is exactly the color of their skin. Because turns out, unlike what L'Oreal and all of these makeup companies have taught people in that space, that there's like 20 shades and you pick a number. What you find is that there's hundreds and hundreds and hundreds of different shades. And so what it does is it scans your face, you answer questions, and then the AI say, hey, this is your color. And then you order your foundation online from Oddity, from Tech-Il Makiage. You order it online. It's highly promoted on social media. And of course, the big advantage of selling makeup is that it's a consumable. So if the women who use the product really like the makeup, typically they'll order again, and so you get a prescription where you get a lot of repeat customer, a lot of repeat buys from people who have found their colors, because when people find their right color, their right product, they don't switch. And so because of that, it's a business that's very similar to Hims, but in the beauty space. And so instead of using doctors for prescriptions, Oddity uses an AI to make a custom cosmetics. But very interesting company. I'm very happy the stock popped at the last earnings, right? And it's cheap at a 0.16. It's pretty cheap. The stock is already profitable with EBITDA margin of 21%. Revenue growth is 33%. Gross margin is excellent in the cosmetic space at 72%. And I'm happy to own this stock. Moving to another lifestyle company, another disruptor of established players. It's On Running shoes. So On Running, actually, if you don't know what they are, I recommend you look up online the color of the shoe, the look of the shoe. It's got a very specific look, and then see if you notice it. And of course, since I've been following this stock now, all I notice is people wearing those shoes. Those shoes are very popular. They are eating away into Nike's lunch and into Adidas lunch, and really On Holdings only has one competitor in in the hipster, trendy, expensive shoe world. There's On Running and there's Oka. And at least that's my understanding. And a lot of people love, I can't remember the name of that company that owns Oka, Outdoor something. A lot of investors also love looking at Oka, which is an interesting company as well. I prefer On Running because they have a very interesting long-term ownership structure. The management team is very aligned, very much for the long run, and they also have this direct-to-consumer sales model where they largely undercut a lot of the distributor. This is something that, say, Oddity does too with makeup. You see, if Nike, for example, has distributors to sell shoes, say Foot Locker, they've been friends, quote unquote, for decades. It's very tough for Nike to undercut the distributor, to undercut the contract, right? On, as a new brand, doesn't have these problems. It can undercut the partnership that it never had, and it can just go direct to consumer and keep a lot of that margin for itself, which is why the margin, for a physical product that requires a lot of labor, 60% margin is excellent. The revenue growth is 34%, also excellent, and at a 0.27, the EV over GP over revenue growth is cheap. And the rule of 40 is achieved at a 45%. So this, again, is a cheap stock. Now, moving on to Celsius Holdings. Celsius Holdings is also a company that looks very expensive if you look at enterprise value over revenue, but they're still predicted to grow revenue at 53% over the next 12 months. So gross margin is very good for the beverage space at 50%. Celsius, really briefly, they are the winning energy drink right now in the United States. Forget about Monster, forget about Red Bull. If you live in the US and you look at people's carts and you look at what people buy a lot of Celsius. These Celsius cans fly off the shelves, and that explains a lot of that revenue growth. Celsius has a much more gender neutral promotion strategy, right? Unlike Monster or Red Bull, for example, who are all about extreme sports, which extreme sports really, it really targets, more male-oriented, more young-oriented, more evening type of beverage. That's kind of what Monster and Red Bull target. Celsius is totally different. Celsius is a marketing that is totally gender neutral. They promote it such that a lot of people have it in the morning, early in the morning instead of coffee. They promote it as a supposedly healthy drink, or at least that's the image that it has. They always show very fit people drinking them. It's like, it's kind of a cliche, but the typical person who's going to have a Celsius, they're going to have like a Lululemon outdoor type yoga pants, and anyways, they're going to be hip. They're going to be hip people, and as a result of that, they're winning. They're doing really well. Their EBITDA margin is 22%, so that's a rule of 40 at a 75. So again, I think this stock has a long runway ahead of it. If you're curious, I know there's this myth against investing in beverages, saying it's the toughest business. A lot of it has to do with the idea that it's difficult to get distribution at the store, but the internet has kind of changed the game, right? Social media has kind of changed the game in how drinks are promoted. And if you look at the returns of Monster beverage, you can see how powerful a drink company can be as far as total returns. And so if Celsius becomes, just half of a Monster beverage, it could have a very outstanding return, well over more than one doubling, perhaps two more doubling coming up for this company. So I'm very interested in it. I'm happy to own it. Another company that I've started buying recently, is Shift4. So Shift4 is cheap at a 0.23. It's one of my cheapest payments company. This is a company that is still guiding revenue growth, that is still expecting some high revenue growth. It's a company that has an EV over GP over revenue growth of a 0.23. So that is, in the top 25% cheapest. The company is profitable at a 14% EBITDA margin. The rule of 40 is a 47. And so if you kind of see where we are, this is a company that has a very top line growth, or like a bigger customer. They focus on bigger customers, right? They focus on sporting venues. They focus on large hotel chains. They have a top-down approach to their sales, kind of the opposite approach of, say, a Toast, which has more of a bottom-up approach. And as a result of their top-down approach, they seem to be winning more and more large deals. And I find the company very undervalued if you compare it to its peers, like even a StoneCo or a PayPal, which are the other two payment companies that I'm going to cover. I find this stock very undervalued, and Shift4 is heavily used in the US. I see it quite a bit. And the CEO of Shift4 is actually a very interesting with its connections with SpaceX. If you listen to the call, you can sense a very modern, very 0 to 1 type of management of the company. This CEO is an overachiever, and you know me. I typically don't invest in CEOs. I typically don't put much credit on CEOs. But if you are a person who puts a lot of credit on a high quality CEO, I would argue the CEO of Shift4 is quite very interesting CEO. Quite a winner for flying a spaceship and all that sort of stuff. Quite a crazy, impressive man, in my view. So moving on to StoneCo. So StoneCo is, I still love StoneCo very much. It's still one of the stocks that I used to love the most. I've been covering StoneCo a little less on the channel because I've been disappointed with the turn that they took. They were pushing, the old management was pushing forward revenue growth, right? And now they don't even guide for revenue growth anymore. Now they guide towards having a credit portfolio, and they guide towards lending. And so that makes my style of analysis, less fitting for a company like StoneCo, because now they're, I don't want to say they're turning into a bank, but they're kind of turning into a bank. And so it seems like this strategic emphasis, in my view, is kind of annoying, right? I wish they still tried to focus on the top line, because this is a business that was growing top line much faster than the 17%. Unfortunately, StoneCo, they've gotten into this whole cash piling theory. I don't know what they're doing with this cash. They have well over $1 billion in cash. They have a buyback program in plan. They haven't even spent that cash to buy back. It looks like they want to save that cash in order for them to grow their loan book, which is not necessarily what I would like to see. If it's turning more into a bank, the valuation of a lot of banks is very depressed right now. Look at SoFi. SoFi has a very depressed valuation despite having outstanding revenue growth. And so we'll see where it goes. The stock is a hold for me. I'm not adding to it. It's a full position. I'm every time I think about, say, perhaps selling this company, I get reminded of the fact that this company is an absolute powerhouse when it comes to cash piling. It's the cash flows are just insane for this company, and as a result of that, it has a rule of 40 of 68, and the profitability that they have, how much cash flow they get to keep, is just insane. They've stopped investing in their revenue growth. Maybe they see some saturation in the field, and so we'll see how that goes. I would like the market to still re-rate this company a little bit and grant it a higher valuation before I'm even interested in selling. So for now, it's a long-term hold. I'm in the green on the stock. If you remember, I was covering the stock under 10 so many times. The bump we got towards 15, 18-ish about 6 months ago, that was a welcome bump, but it seems like that bump is fading a little bit, and so I'm waiting for that stock to kind of return, but it's spooking the market with the talking about the lending, knowing that they already had a bad experience with lending, right? They already had a bad experience with their collateral system, and they're going back into it. I don't know if it's the right strategy, but we'll see. Right now, I still own the stock. I still like the stock, but in my last coverage of StoneCo, I called it kind of a boring stock, and so that's kind of what it's becoming. It's becoming some sort of a boring stock. Well, it used to be very exciting with payment terminal, and anyways. That's not how I invest, right? I don't invest on whether I find a stock exciting or not. I try to look at the data and the numbers as much as I can. Moving on to PayPal. So PayPal, again, I put PayPal in there as a comparison. This is a stock that I'm out of. I'm out of PayPal at this point. I find the growth just to just be subpar at 8% revenue growth. I mean, PayPal is everywhere. Everybody uses PayPal. Are we going to see a doubling in the use of PayPal in the next 3 years? Absolutely not. I don't think so. Are we going to see a doubling in the use of Shift4 in the next 3 years? Absolutely. Are we going to see a doubling of the use of StoneCo in the next 3 years? Well, maybe if they get back to revenue growth, maybe if they get back into investing, into gaining new small businesses, maybe. PayPal, I don't think you're going to see a doubling in the revenue growth in the next 3 years. And as a result of that, that price to sales, that EV over revenue of 2, as a result of that, maybe it is warranted. Not a bad stock in any way. This is just a savings account stock, right? It's in my view, that's what I call a savings account stock. You just put the money in there, and in case you see a better opportunity, you can sell some PayPal, buy a better opportunity. I think it's undervalued compared to a lot of the market and a lot of the other numbers, but like I said, my style of investing is product adoption. PayPal is very pervasive. It's everywhere. It's a very popular company, and so as a result of that, I don't see too much growth coming for them. Moving on to MercadoLibre. So MercadoLibre, leader in Latin America, very big in Mexico, in Argentina, in Brazil. What do? They're mostly an e-commerce website, but they also have a fintech division that is doing quite well. The revenue growth is predicted to be 29% within the next 12 months. The gross margin is 57%. This is a stock that is cheap on my enterprise value over gross profit over revenue growth metric at a 0.34. That's a cheap stock. The EBITDA margin is high at 18%. MercadoLibre, the rule of 40 is 47%. So there again, really outstanding number here, and I'm happy to own it. It is also a 5-ish% position for me. Moving on to two other stocks that I own. One of them I never cover in the channel is Amazon. I never cover it because it's a savings account. But C Limited I own. I'm happy to see the return of the success in the e-commerce division. I'm happy to see the return to growth across multiple divisions of this company. C Limited, CSEA stands for Southeast Asia. They are the makers of C Money, which is a fintech in Southeast Asia, Shopee, which is an e-commerce site leading in Southeast Asia, especially Indonesia, and then they have a gaming division called Garena, but especially one game called Free Fire, which is a leading mobile game. The company is doing well, predicted to grow at 12%. But that's a company that used to be growing much more, and it's may get back to growth in my view. I like that the company has gotten back into growth and gotten back into investing, and I plan on owning this one for the long run. The last company that I'll compare these two e-commerce stocks to is Amazon. Now, Amazon, you may say, Amazon is mostly in the cloud business. Well, yeah, that's true. But if you were to just look Amazon for the e-commerce business, you would find that the valuation is actually fairly compelling at a 3 times revenue. 3 times revenue. I mean, if you look at the size of this company, it's just insane. $2 trillion valuation, $590 billion in sales. Trading at 3.3 times revenue, but still growing at 11% despite that base. That's just insane, growing this fast when you're this big. Gross margin is 48%. It's a 0.64, a little pricey, but this company, I believe, has proven itself as a juggernaut. Has proven itself as a very strong, solid company, and they are optimized for making money. EBITDA margin is 16%, so you get a 27 on the rule of 40. So not quite a hyper growth stock. I consider Amazon a savings account stock. It's if we see a market-wide collapse, I expect Amazon to be a stock that resists much more, and then that's a stock that I could sell to buy stocks that dropped a little more than Amazon. And I like Amazon very much. It's an old position for me, but I don't count it in any of my portfolio. I don't include it in any of the assessment of my portfolio. It's just a stock that's sitting there, savings account type stock, as I call it. And this was it for this list. This was a long video. But anyways, remember, not investment advice, not financial advice. This video is just entertainment. I hope you were entertained. Please like, please subscribe. Thank you for watching and have a wonderful day.